This is a story about fairness. When SpaceX went public last month, investors were invited to buy into one of the world's most valuable companies. But they weren't buying equal voting rights. Instead, the IPO cemented Elon Musk's extraordinary control over the company's future, giving him more voting power than all other shareholders combined, as well as locking him in as chairman and CEO.
SpaceX, as a public company, is an investment in Elon Musk and the cult of Elon.
Well, you know, I visited SpaceX. It's extraordinary. It's extraordinary what they've done.
This has captured the imagination not just of investors, but really everyone.
The reality is it's going to be a watershed event in terms of the space sector for Musk.
Our job as institutional investors is to take calculated risk, and in the case of SpaceX, we simply could not make the numbers add up.
Historically, public companies were simple matters where each share gave the holder one vote, something still true for companies like Apple. But some founders decided that they needed and deserved a more than equal say in the running of the company, giving rise to two classes of shares, with some shares attached to multiple votes. A dual-class share structure, which is the case for companies like Alphabet and Meta. Lise Buyer is an IPO advisor and the founder of Class 5 Group. She says one advantage of the dual-class structure is that it allows companies to get their sea legs as they adjust to being public.
The biggest thing is actually keeping activists away when the stock falls. And so what that means is founders can make decisions that may actually have a negative impact on the near term without fear that if the stock falls on that news, someone will swoop in and take it away. From an investor's perspective, it's a double-edged sword. Investors, on one hand, can rightly feel, you're taking my money, I want to vote. On the other hand, investors, no matter how savvy they are, don't actually know what's going on inside a company. The dual-class structure provides a safety net for those investors who want to let management make the decisions they deem will work out best in the long run without fear of losing their jobs if, in fact, there's a short-term hiccup.
The dual-class share structure gained prominence with Ford's landmark 1956 IPO, allowing the Ford family to retain control even as the number of public shareholders grew. A similar two-class model was adopted by some media companies like the Washington Post, the New York Times, and Fox. But what was once the exception is rapidly becoming the rule today. In 1980, just over 1% of IPOs used dual-class structures. By last year, that figure had climbed to 47%.
They were not common in any other kind of public stock until Google came along in 2004, where the founders had some very specific ideas of how they wanted to run the company.
This paved the way for SpaceX to file for an IPO under an unusually extreme dual share structure. While Musk holds just over 40% of the company's equity, he controls over 80% of the total voting power. Lucian Bebchuk is director of the Corporate Governance Program at Harvard Law School.
What we have here goes much beyond just letting Musk determine the business strategy for some time. First of all, even if you believe that Musk is now by far the best to choose the business strategy of the company, this doesn't mean trusting how we will then allocate the pie that is generated by the company between public investors and himself. One key role of corporate governance arrangements is to constrain insiders from allocating to themselves an excessive slice of the pie at the expense of public investors.
There's also the question, even if you believe wholeheartedly in Elon Musk today, Elon Musk may not be there or be the same Elon Musk 30, 40 years down the road.
Yes, David, here you are completely correct. Furthermore, the governance structure that entrenches control in the hands of whoever has the B shares is indefinite, which means that if Elon Musk or when Elon Musk passes away, we are all mortal, then investors cannot rely on Musk's heirs or whoever manages the trusts through which his high voting shares are held, that they would be the most fitting leaders.
And then there's the question of how to ensure that a superstar CEO remains fully committed to the company over which he has nearly complete control, something that's been an issue before for Mr. Musk at his other venture, Tesla.
A similar concern arises in connection with SpaceX, because even though in the governance structure of SpaceX there is an ironclad commitment to have Musk in the CEO and chair positions, there are no constraints whatsoever on how much time and effort he will spend outside SpaceX.
The world is well aware of the extraordinary SpaceX governance structure, and it gives some potential investors pause. Anders Schelde is the Chief Investment Officer of AkademikerPension, a Danish pension fund that manages more than $20 billion in assets, primarily on behalf of academics. It recently placed SpaceX on an exclusion list for investments, specifically citing the company's catastrophic governance.
Maybe the Elon Musk brand is very strong in the US, but it's not so strong in Denmark. Actually, I would rather say that many people driving a Tesla is maybe a little bit embarrassed about it, and certainly among our scheme members, there's a huge reputational risk in investing in an Elon Musk-led company. So I've been here for 9 years now, and I never experienced in my 9 years as CIO so many scheme members coming back to me with positive comments from a single investment decision as I experienced in the wake of the exclusion of SpaceX.
What do you look for in governance, either to have or to avoid as you make investments?
We hold good governance very, very highly. We think it's extremely important in order to assure accountability and transparency and sound decision making. And I think good governance to us, to our mind, really lies at the core of the trust that we need in public markets. One share, one vote. The distribution of power should be proportional to the money invested. We have the separation of power between CEO and chairman of the board. We don't like that to be the same person. We think that creates a risk of poor decision making and excessive risk taking. And finally, the third principle is independence. We want an independent board.
Do you see a trend, or are you concerned about a trend, with the success of SpaceX that other companies may follow suit with respect to corporate governance?
I definitely fear that this might inspire other to go in the same direction. We could be heading in that direction of even further concentration of power with a few founders in some very, very major companies. And I think that is in that environment, it's important that we as institutional investors try and pull in the other direction to get the balance right.
When the balance so unevenly favors one person's interests, what power do the rest of the shareholders have? After all, it is also their money that's on the line.
Investors do have one really important tool at their disposal. They don't like what's going on, they can sell the stock. That's their point of leverage. Retail investors, to be quite honest, don't have much of a say anyway, because most of them don't have enough voting power to make a difference. So should they care? Sure, because there should be some forcing functions on management teams to remember that they have sold stock to the public in return for committing to run the business like a public company.
Ultimately, it will be for markets to decide whether that balance of power is fair for all shareholders or tilts too far toward the founders. As always, the markets speak most loudly through the value put on the stock. And at least at the beginning, Elon Musk is not facing too much pressure, given SpaceX's initial market cap of over $2 trillion.
Whatever value you estimate and you attach to the business prospects of SpaceX, you need, as an investor, to discount it significantly because of the governance flows. Did the market attach such an adequate discount? We cannot tell from what we see in the market, but I think it would be important for public investors to do so. And I hope, David, that this interview might help a little bit in informing public investors about this issue, to which they should pay close attention.